Hey guys, back with another weekend update video. It is Sunday, June 14th. It's just after 6:30 p.m. And the first thing I wanted to do was I wanted to recap my profits and losses, even though, technically I didn't have any loss from this past week, just so we're all on the same page and just so to kind of do a kind of weekly summary of my positions. So if you remember from my prior videos from this past week, I currently own 200 shares of AMD at a stock price of $52.95. So right now I have 200 shares at $52.95 each. So I have $10,590 that are invested essentially in AMD. So right now you can see the market closed Friday at $53.67. So right now I am profitable. I'm $53.67 per share minus my cost basis of $52.95. I'm up 72 cents per share times 200 shares. So right now I'm up $144 on my 200 shares of AMD in total. However, I'm not going to include these in my weekly gains because these are not realized gains, meaning I haven't sold my position yet. So this is just all theoretical if I were to sell my position at this same strike price of $53.67. So like I said, I'm going to talk about what my strategy is come tomorrow and for this week, but I just want to recap what my positions are. So I have $10,590 that are essentially tied up in AMD shares. And if you remember last week, I had also sold 2 covered calls on AMD because I wanted to get those shares taken away so I can do a one complete rotation of the wheel strategy. So I had sold a $55 covered call and I sold 2 of them for $55 in premium each. So I collected a total of $110 for my 2 $55 covered call contracts, okay? And I had also sold a 50 strike put on AMD for $36 in premium. So in terms of my options plays for this past week for AMD, I collected a total of $146 in premium, okay? So now I told you that I had $10,590 of my money that was tied up in AMD shares. And if I add $5,000 to that, because my 50 strike put, I have $5,000 in collateral that is also sort of tied up in AMD for that past week. So I had a total of $15,590 that were allocated towards my AMD plays in terms of the put, the covered calls, and the shares. So I made a total of $146 in realized gains, right? So this is, like I said, this is not taking into account the stock appreciation because I haven't sold the shares yet. So I made $146 divided by $15,590 in total money that was allocated to AMD. So I made, make that a percentage, so I made 0.94% return on that money in 1 week, which is very good in my opinion. Now the other play that I had on was on Micron. So if we just go to the Micron stock chart real quick. So Micron, I sold a $49.50 strike put and I collected $27 in premium for that put. So that meant that I made $27 in profit out of the $4,950 in collateral that I had to hold in cash in case I got assigned shares, which I did because if you notice, the stock price of Micron at the end of the day Friday was $48.79. So since it was below $49.50, I got assigned 100 shares of Micron at $49.50 a share. But we'll get into that a little bit later. So my $27 in premium that I collected divided by my risk or my collateral, that was a return of 0.55% on my risk, which again is not that bad because like I said, I like to shoot for at least a minimum of 0.4% return on my risk. I played it extra safe with Micron compared to AMD because this was my first time ever playing Micron. And I'm kind of glad I did because since we had that big drawdown on Thursday and we kind of essentially traded sideways on Friday, I got assigned shares that are not that far away from the current stock price. If I was more aggressive, and let's take a look at the Micron options chain. Let's say I was more aggressive because at the time Micron was trading in the low 50s, I believe. If I had sold, let's say like the $51 strike, well, I would be more in the hole because I would own the shares at $51 each, and right now it's trading at $48.79. So because I was very conservative and picking a strike price that was, I believe it was 85% out of the money, or had an 85% chance of profitability, then I am not too far in the hole, meaning I'm less than $1 away from my cost basis in terms of what the stock is trading at currently. So if I add my $146 in realized gains from my AMD positions, and I add the $27 in premium that I collected from my Micron put, that leaves me with a total of $173 for the week. And if I divide it by the $15,590 that I had tied up in AMD, plus the $4,950 that I had tied up in Micron, that's an overall return on risk for my week of 0.84%, which is very good. I mean, again, just to do a quick and dirty annualization, if I can do this every week, I would earn roughly 44% return on my money in the year, or over the course of a year, I should say. So I'm very happy with that. My only concern now is with what's happening in the market currently. Because of the big drawdown on Thursday, and then we traded sideways on Friday, I still own 200 shares of AMD because my covered calls were at a strike price of $55 and AMD closed below that. So it's good in that I was able to collect premium, but it was bad because I personally wanted my shares to get called away because I wanted to go into this coming week all cash. So my current positions right now are that I own 200 shares of AMD at $52.95, and I own 100 shares of Micron at $49.50 each. So I don't have much left in my portfolio in order to trade with this week. I have roughly $5,000 left. So if I wanted to, I could open up another cash secured put on AMD at the $50 strike price or less, which would give me a good return on my money. I mean, if I'm looking at the options chain, I would probably I want to be extra safe this week because I don't know what the market is doing right now. It's kind of up and down. Some people are calling it a kangaroo market. It's no longer a bear market or a bull market. It's a kangaroo market because it keeps going up and down and up and down. But if I were to open up a position this week, I would play it extra safe. And by that, I mean like a 90% chance of profit or higher, just so I can collect a little bit of premium. I mean, this $47 strike, looking at it right now, is looking pretty good to me because it's pretty far away from where the stock is trading at right now. And I still collect $22 in premium. If, this is where the numbers are when the market opens tomorrow, well, let's just do a quick return on risk calculation. So $22 divided by 4,700, that gives me, 0.46%. So I could probably even go lower to the $46 strike. Let's see, $16 divided by 4,600. Yeah, so that's a little bit less than 0.4%. So I think if I were to make a play at all this week, I would probably sell the $47 strike cash I could put on AMD just to collect a little bit of premium. But my goal for this week is to get out of my shares of both AMD and Micron. So let's go to the charts. So my concern, so this is where, people ask me, it seems like the wheel strategy is the best strategy in terms of options plays and you can't lose. Or they ask me, what is the downside or what are the risks with the wheel strategy? Well, what's happening right now is the one big downside and the one risk with the wheel strategy. So the risk is that you get assigned shares at a certain price and then the stock just plummets. And then now you're bag holding shares that you bought at a more expensive price than what the stock is currently trading at. So for example, AMD is not the worst case scenario right now because AMD closed at, let's see, what did we say it closed at? It closed at 53.67, okay? So I own AMD at $52.95, but that's because I got assigned the shares in a previous week. So I'm still profitable on AMD. But if we take a look at Micron, and again, I'm not that bad in a position in terms of Micron, but let's just say hypothetically, you got assigned shares of Micron at $53. Let's just say in theory, or hypothetically, you sold a $53 cash security put on Micron, and obviously Micron closed below 53, it closed at 48.64. So what that means is right now, I could go into the market and buy Micron for $48.64 a share. But you got assigned at $53 a share. So you overpaid in theory. I mean, yes, you collected a little bit of premium as well, but that premium is not enough to account for, roughly $3 worth of price difference per share. So the biggest fear is, let's say you own the stock at 53, and then Micron just continues to bleed down to 30, to, let's say 45, 40, 35, 30, whatever. And that's the problem, because now it would be the same thing as you just buying shares at 53 and then the stock going down. The only way to recoup your losses are to wait for the stock to come back up or to keep selling covered calls as it's going down. However, the problem is that once there's a big difference between your cost basis price and where the stock is currently, the bigger that difference is, the less premium you're going to collect if you just sell covered calls at your break-even price or higher. So for me, I got assigned shares of Micron at $49.50. It's currently trading at roughly $48.50, so $1 less. So if I wanted to sell a covered call on Micron, I'm going to get good premium because the price difference between my cost basis and where Micron is trading at is not that high. So let's just see. If I want to sell a covered call right now, assuming everything's going to stay the same, at my cost basis of $49.50, I could collect $126 per contract. And I only own 100 shares, so I would only sell one contract. But I could sell this option and collect $126. But let's say, in my hypothetical example, let's say I own Micron at $53 a share. You see how there's such a big difference between the strike price and the current share price? I would only collect $29 per contract if I was going to sell the 53 strike to try and get to my break-even price. The problem is that you can be okay with that, meaning you can just collect a little bit of premium, because that way there's no risk for you of having a loss. Because if the stock price goes to 53 or higher, you're going to break even plus collect premium. Now, let's say this week Micron just tanks and it goes from 48 to, let's just say, $38 a share, right? So now you can imagine and you can see that if Micron's trading all the way down here, there's a big difference between where the stock is trading at and, let's say, your $53 cost basis. So your premium at that point is going to be like $1, if that, right? So then what do? Your two options are basically, actually you have three options. Just cut your losses and just sell the stock and accept the loss, meaning you own the stock at $53, but you're going to sell it for, let's just say, $43 to make it a nice number. So you're going to accept a $10 loss per share just because you want to free up your cash and you don't want to wait. That's option number one, is to essentially cut your losses. Option two would be to just keep selling covered calls at your cost basis, and hopefully, the price difference isn't too much, so you still collect decent premium. But even if you collect $1, you're okay with that, because there's no risk for you at that point, because there's no risk of you taking a loss, because worst case scenario, the stock is not going to reach your strike price and you'll just collect free premium, however much or however little it may be. Or the stock goes above your strike price, your shares get called away, and you collect premium. The third option is, if the stock price just drops and it's really far from your cost basis, you can sell a covered call that's less than your cost basis. So let's say you own the stock at 53 a share, and right now Micron is trading at $30 a share. Well, like I said, I would be willing to bet that if that was the case, the 53 strike covered call would probably get you like $1 in premium. I mean, if we go all the way up, you see the stock is currently at 48.79. If you were to sell a 62 and a 50 covered call, you get $1 premium. 60 would be $3 in premium. And not only that, it's going to be really hard to get this filled because the volume is going to be much less if it's really far out of the money. Your third option, like I said, is let's say the stock is trading at $30. You can sell a covered call at, let's say, $45, which is a decent margin away from the current stock price, but below your cost basis. That way you collect decent premium. So the benefit there is you collect more premium. However, the risk is, let's say Micron rallies back up and gets to 45 or higher. Well, now you're gonna get a loss because you were forced to sell your shares at $45 each, even though you paid $53 each. So yes, you'll collect premium, but that's the risk you run by selling covered calls less than your cost basis, is that if the stock rallies, you're gonna take a loss. You're gonna have stock depreciation. So those are really your only three options, and those are my three options right now in terms of my AMD and Micron calls. With AMD, it's a little different because I'm already profitable because my cost basis is $52.95 and it closed above that. So let's just say Monday morning, if the market opens at 53.67 again, I could instantly just sell those shares and just collect my money and then be cash in AMD. And I'm seriously thinking about doing that just because my fear is that we're at another top and that the market is going to just drop again. And if that happens, then the scenario that I just laid out, that's the risk with the wheel strategy. So my objective for this coming week is to become 100% cash as quickly as possible. Now, I don't want to sell for a loss, right? I don't want to do that. The reason I pick good stocks is because I'm okay holding them long term. So I'm okay with that. I'm definitely not going to sell for a loss. At the bare minimum, I'll sell to break even. So like I said, right now, I'm profitable on AMD. So if AMD opens above my cost basis Monday morning, I'll feel it out for the first 5 or 10 minutes, maybe 15 minutes to see what the market does. But what I think I'm going to do is as soon as the market opens on Monday morning, I'm going to set a stop loss at $53. So that way I'm guaranteed a profit, meaning if AMD starts dipping, it'll automatically put in a market order to sell my shares at $53 a share. So I'll break even / collect a little bit of profit. That way I protect my gains and I won't have to watch the stock, like a hawk all day long to see if it's dipping. So that's probably going to be my strategy for AMD, is to set a stop loss at 53, watch it for a little bit. If it rallies for the first 10 or 15 minutes, let's say it gets like $54, I'll just sell it off right away and just take my premium and then get cash, because that's my objective for this week. I'm not worried about gains. I'm not worried about maximizing my profits or my return on risk. My goal this week is to just get as much cash as possible and not own any shares of stock until the market kind of sorts itself out right now and we kind of figure out, are we going to dip or are we going to keep rallying? Now, my strategy with Micron is going to be a little different because I'm technically at a loss right now because I own Micron at $49.50, but right now Micron's trading at $48.79. So I'm actually in the hole 71 cents per share, and I have 100 shares. So I'm actually in the hole $71 on Micron. And these are unrealized gain, or unrealized losses, I should say. So I need Micron to rally to $49.50, and then I'm going to set another stop loss if that happens. So I'm going to try to do the same thing with Micron, in that if Micron starts rallying, once it goes to let's say $50, I'm going to set a stop loss at $49.50 just to lock in a break even. And then again, I'll watch it and see if it gets to $50.50 or something like that, then I'll just sell the shares straight off. I'm leaning against selling covered calls on Micron and AMD again, because that essentially means that I have to wait until Friday to figure out what's going to happen. And the way the market's been so choppy the past 2 days, I don't want to do that, because maybe the market goes up Monday, Tuesday, Wednesday, and then it goes back down Thursday, Friday, and then I'm back in the similar position as I was this past week, where it's so choppy that my shares don't get called away because my strikes are above the share prices. My number one objective, and I'll say this again, I think for the third or fourth time, is that I want to get my shares sold away, and I want to be 100% cash, because I don't want to risk bag holding for another big dip. So that's my goal, is to hopefully have Micron and AMD rally above my cost basis, and then set stop limits at my cost basis so that I'm guaranteed not to have a loss. And then if I see a decent profit, or anything that's like $50 or more, I'll just go ahead and sell off my AMD and Micron shares. Now, once I sell them off, or if I sell them off, let's say that happens Monday, I'll probably have to wait about 2 or 3 days for my cash to settle if I want to make another option play for this coming week. Like I said, I already have $5,000 in my account that I can play with, but I think I'm going to hold off. I think at the very least, this coming Monday or tomorrow, I'm not going to open up any new positions. I'm only going to look to try and get out of my shares of AMD and Micron. So that's my strategy. That's my thought process. I know that was kind of a lot to absorb, but let me know if you have any questions or comments. Let me know. I'm assuming I'm not the only one that got assigned shares this past week. I'm sure a lot of people got assigned shares on their cash secured puts. So let me know what your strategies are, what your plans are, and I'm curious to hear what you think about my strategies. But, I'm not saying I'm bullish or I'm bearish. I just want to be prepared, right? Like I said, I'm not here to pick direction or pick sides. I'm just here to make profit and make safe and consistent profits. I don't care if they're small or large. I'm not trying to hit home runs. I don't want to be the guy that makes $500 one week, loses $300 the next week, makes $200 the next week, loses $400 the next week, and it just goes, it's like a roller coaster up and down. And then at the end of the year, you're just hoping you're net positive. Now, I'd rather be the guy that consistently makes $100 one week, $50 the next week, $150 the next week. That way I know I'm always in the green, hopefully, knock on wood. But yeah, so this is, the most popular question, like I said, I get asked is, well, what is the risk with the wheel strategy? What is potentially happening right now in the market is the number one risk with the wheel strategy. And that's you getting assigned shares and the stock market or your stock just drops in price and you have a hard time getting out of them. I'm fortunate right now that my cost basis values are not very far away from the share prices. So just in a normal daily fluctuation, I think I have a good chance of getting out at a break-even price, or maybe even for a small profit. Like I said, if my cost basis was like $5, $10 away from the current share price, I'd be in deeper trouble. But hopefully none of you are in that position. Hopefully you're in a similar position to me, where you're likely or hopefully fairly close to being able to break even or sell out for a slight profit. But anyway, as always, if you have any questions or comments, leave them below. Thanks for tuning in. And one other question I just want to leave you with is, people ask me, what order to watch my videos in, or if I can group them together. I've created a playlist called The Wheel for all of my videos. So if you just start the playlist, the videos will cycle in order, and you can just leave it on autoplay and it'll just, go one after the other. So you don't have to think about, picking which one comes next or anything like that. Just go to my YouTube page and click on playlists, and you'll see one playlist for the wheel videos. And right now I've made two kind of educational videos, one on the RSI, which I just released yesterday, and one on the Fibonacci retracements. So I'm also creating a playlist for that, but I only have 2 videos in that series so far. But anyway, thanks for tuning in and happy trading.